Good morning, traders, and welcome to this live intraday strategy webinar on SB Trade Desk. Today is Wednesday, November 1st, FOMC day. Welcome aboard to the start of November trade. Lots to cover today, guys. Markets have been in very frustrating holding pattern on some of the majors. Euro yen saw that nice pop, so swing trades are in on that. But certainly a lot to cover today ahead of the FOMC interest rate decision. Good to see everyone here in the room. Iman, Kelly, Pete, Pooja, Peter, the whole crew is in the house. So on the menu for today, we got the DXY, Aussie dollar, which continues to hold a opening range right above support. Dollar yen, the abomination, turning right up, right back towards the highs of the week. Pound dollar progressing nicely. Swissy with a nice little rebound. We want to talk about Kiwi as well, which is responding to near-term support. You got a nice little pop yesterday on some decent employment data there. So we'll take a look at that, and obviously, as I noted, Euro Yen. Just want to take a quick, brief look at Bitcoin, guys. You know, I just dropped a daily chart in there yesterday to show you. You know, obviously, there's some news today that the CME is actually looking to offer Bitcoin futures before the end of the year. Again, as it gains more traction, you know, fuels speculation into it. Like I said yesterday, it's all emotion from here. So as far as the Bitcoin rally, you do have some soft targets up higher we'll look at, but largely speaking, if you're not already in it, there's nothing there for you as far as new positioning. And we'll take a look at Ethereum, which I also highlighted yesterday. If it is the laggard, you know, it still has some upside to go on that. So that's what's on the menu for today. If there's anything that you didn't hear or something that you'd like to cover, any questions or trade setups, as always, feel free to throw them on the message board at any time. All right. We got ADP employment today. It came out better than expected. I think the print, let me just review it real quick. We were expecting a print of just 200,000. It came in at 235,000. We did see a slight downward reduction to the previous read from 135 to 110. So you're seeing the dollar has seen a little bit of a bounce higher here. It's still holding those levels, but at the end of the day, you know, you still have ISM data at 10 o'clock. The major hitter obviously will be the FOMC interest rate decision. Going into that, markets are not really expecting anything. If you look at the November expectations, we're pretty solid, a 99% chance essentially that we're going to hold interest rates at 1 to 1.25 today. The devil's in the details, okay? It's all about the policy statement and if there's any changes to that. I'm going to read you some research, guys, some proprietary research that we get here from a group called Prattle. I've shared this with you before. They rate and grade central bank rhetoric on a scale to help them identify what stance you know, the central bank is steering towards. This is what the Fed, their scoring system has been showing us as of late, showing that the Fed rhetoric has really tilted way more aggressively to the hawkish side in recent months. I'm just going to read you this little note that they sent us earlier today. The second to last FOMC meeting of the year is likely to be uneventful, but the Fed will almost certainly make news this week with all eyes fixated on who Trump appoints as the next chairperson. That's something I noted earlier in the week. Economic conditions remain strong with inflation nearing target, GDP growth strengthening, and employment statistics rebounding to nearly pre-hurricane levels. Solid fundamentals place the Fed on firm footing to raise rates later this year, despite stimulative monetary policy continuing abroad. Even though the economy is strengthening and the Fed sentiment is rising to a momentum of 0.15, policymakers will likely wait until December FOMC meeting to hike rates. At that point, by that time, President Trump will have likely announced his nominees for not only the chairperson, but also several other vacancies on the Federal Reserve Board. So it's sort of a little summary there of what they're looking at heading into today's decision. Really, tomorrow is when we get the announcement from Trump, or at least that's what the White House has disseminated with regards to his pick for chair. That's probably going to be the bigger market mover. Okay, if the policy statement is left unchanged, like I said, December is pretty baked in. Market expectations are already calling for essentially a 97% chance that we're going to see a quarter to $1.05 on the interest rate heading into December. Remember one thing, guys. The market has, or the Fed rather, in their quarterly projections, has already disseminated expectations for roughly 4 hikes next year. If we look out into August and we look out to later months of next year, the market is only pricing in 2. Okay, so there is a disconnect there. If they come out much more hawkish, or if the Fed is appointed someone whose chair is leaning towards more of a hawkish stance, you're likely to see the market start to price in that expectation. Right now, they're discounting two hikes, and they're looking for just 50 basis points heading into the latter part of next year. So with that said, all the fundamentals out of the way, let's enough of that trash. Let's talk about what the market's doing. So keep that in mind. 2 p.m. today. Again, the midweek strategy webinar, as I noted yesterday, guys, got pushed back to tomorrow to accommodate for the interest rate decision. Obviously, tomorrow we have the BOE on tap too, so we want to take a look at the pound crosses heading into that, which is likely to be a big market mover for the pound. All right. Dollar index, here's what we look like right now. Here's what we looked like earlier in the week. There hasn't really been much need to update this chart. The focus is on this long-term, weekly trendline resistance. We talked about that. The daily chart also highlighted that trend line right there. We opened the week just below. Key support and near-term bullish invalidation is right at the 94 handle. As long as you stay above 94 handle, the focus is on this range. A topside breach, and you really have nothing until basically 96, 95.90. So the level that you're opening the month and the week at is critical. Here's the formation as it stood on the Sunday open. Again, we were looking for that move lower. We did see a break lower here, and we fizzled out before recovering. So the dollar index is kind of just carving out an initial weekly opening range here. Major event risk on tap. Use caution here. To be quite frank with you guys, I'm super trigger shy. Again, into the close and open of the month, I'm just notorious. I know myself. It's not usually the best time for intraday trades. That being said, the levels are clear. It's just the momentum and directional bias on the immediate stance is not very clear at this point. So if the dollar pops higher, again, this formation puts near-term resistance somewhere around 95.50. Again, 96 is a critical region from a Fibonacci standpoint. There are a lot of considerations there, including the 100 off the low and the 38.2 off the high. That gets you 95.90, 96. And there's that 94.20, former swing highs, 94.27. That's the break we really need to see to give validation for a little bit more of a stern turn to the downside in the index. Gunshot approach, guys, and this is, again, just my humble opinion. I do think this thing's going to pop and then drop. I still think the momentum, it really couldn't turn much lower. Even on the near-term charts on that decline that we made earlier in the week, holding 40 as support. So it's just not there yet, I think, in my humble opinion, for us to get aggressive on the short side just yet. If we get a break below that median line, I think it'll be a start. That'll also be an objective break of the weekly opening range lows. But again, you have this former highs, that spot right there into 94.20. That's kind of what I want to see break on the downside. Now, we do still have NFPs on Friday, too. NFPs are expected to come in at a print of 310,000. That's off of last month's dismal contraction of 33,000. Remember, because the hurricanes and all this. So that would more than make up the difference and certainly put us, put that labor market picture or outlook right in line with the Fed's expectations. So that might not upset things at all, but a stronger print, again, further fuels the flame. Any questions on the index? Any questions on the FOMC? Any questions on implications for the dollar? Not really expecting much from the announcement, just to see that the policy statement keeps us on course for that December hike. And tomorrow, that decision on the next Fed chair is likely going to be the bigger market mover. Okay, that's DXY, number one. Number two, I want to jump right into the Aussie, because that's kind of the one I've been also really liking lately. We've been talking about this major area of critical support on Aussie dollar. It's basically defined by former trendline resistance, current slope support, former trendline resistance, current slope support, and the 38.2, not only just of the larger advance, but also the 618 of just this near-term advance, all coincide right here. So momentum obviously still has some room before 40, but you get the picture. You're looking for some sort of exhaustion while above this region. At the same time, It's the start of the month. It's the start of a brand new session, and if we were to break and close sub 76.30, 74.70 is your next sort of likely level you'd want to pay closer attention to. So based on this sort of broader outlook on the weekly chart for Aussie, the emphasis or the major focus is still for price to break here if this downtrend is going to continue further lower. As it stands, downtrend's at risk well above this level. Aussie dollar on the daily shows a similar scenario, basic trendline support off the yearly lows, 618 retracement confluence. This formation we talked about yesterday, I don't really want to put too much emphasis on it, let's say that, specifically on the 50 lines here. I'm really just largely seeing if this slope is going to hold, but in any event, that 76.30 level comes up as a big, big region. If not, that's that downside break, and again, the weekly chart highlights that as that 74, 76 level right there. Intraday looks like this, and here's what we look like earlier in the week. So on the Sunday open, we were at 76.76, right back at former support, now resistance. You saw us pop through that on the drop yesterday during the webinar. We were looking at this as we're trying to make a push lower. We wanted to stay constructive above 76.32, so a stop against that low actually panned out pretty well. Now again, you're coming right back into the weekly high, so the weekly opening range has taken shape just above key support, and these are typically going to be our best plays, okay? Because the definitive break, specifically with all this event risk on tap, is going to be pretty clear on this. So if we make a break sub 76.30, look for that dump into 76 rather, for the initial target on the downside, but I'm more inclined to look higher still. Now, a couple of things to take note of. On the 120-minute chart, you can see that the momentum is holding sub 60. That's not really very encouraging for a broader shift. It is early in the session. It's early in the month, so I'm not going to go too crazy on making assumptions on that. But the broader focus is on a break of this range, the high that we made yesterday at 76, basically the 77 handle, and that 76.30 region. Median line of this pitchfork seems to be holding Aussie dollar resistance, 4th of October high. Let me see what you're talking about, Pooja, there. The October 4th high. So it depends which high that you use. I would probably use this one, which is the 19th. Oh, that's what you have, the 19th, right? I gotcha. Yeah, so you see the median line there. Could be a play. You see that again? Interesting. Yeah, Pooja, it is definitely, possibly a slope that's in play here. You can see the 3 touches that you're looking at here. It does give us a little bit more conviction. It does give the downside a little more room, basically into last week's low, and I'm okay with that as being sort of the level that you want to see hold support. But either way, based on where we are in the month on that weekly chart, the daily chart, the fact that even on the momentum scale, the daily has held 30 as far as the oversold region, still puts the emphasis on a break of this region. What I like about your slope that you're talking about here is the downside converges and gives us a little bit of a clear target in time of where we should look on this downslope if it breaks. And that's basically somewhere around 75.50. I had 75.66. So something to keep in mind. But right now, the focus has to be on a break of this near-term range. Does that make sense, Pooja? Could be in play. I tend not to get too intricate with the embedded pitchforks just for your sake, guys, so the charts don't look crazy on your end. but it does certainly suggest, again, that we do need to see a break of these highs, essentially, which would shift the focus back towards those upside targets. Yes, maybe we can play the upside if the ML breaks, but not until then. Yeah, I mean, as I said, Pooja, the upside on your slope highlights this. My upslide resistance, or at least upslope my resistance rather, the trade I'd be working against on the short side would be 76.97, or basically 77 handle. As long as you stay below the 77 handle, yeah, I wouldn't want to get aggressive on any longs. Absolutely not. But even if we peek through these highs, just stay as objective as you can. The weekly opening range is 77, so I wouldn't want to get long unless we cleared that level. Now, let's say, just for argument's sake, that this thing tanks right here into 76.32 again into the U.S. trade session, and you see failure or exhaustion ahead of that low. On a long trade, if we're trading the inside of that range, Pooja, I would look to take a little bit of profit off, yeah, at that slope you're looking at. But we do need to break the weekly high for this thing to get going. It's just, you also need to keep in mind the weekly high, Pooja, came in right at the 200-day moving average. So again, a lateral level of objective resistance that we want to keep an eye on for the Aussie. Make sense? Says okay, thanks. Hey, you're more than welcome. Okay, any questions on Aussie? Still holding above that key support barrier. Let's see if we can't get a break of that near-term range. That's number 2. Number 3, the abomination. You know, I'm going to just throw my hands up in the air here, so I don't want to encourage you guys to test this thing again. You know, as we came into the start of the week, dollar-yen was right at resistance. It looks pretty clear for a short, in my humble opinion. 113.25 was the initial target. The second target was down here at the monthly open at 112.64. We never got it. So here we are, full round trip right back, but you know, even though we broke the initial weekly range highs, this is still critical resistance. We've been talking about that region for a very long time. It's the 618 retracement from the decline off the December highs of last year, or excuse me, of this year's range. And again, you have those former swing highs from earlier this year in May and July. So it's going to be interesting to see how what this does today. I have no clue. I have no clue. Again, a gun to my head, I would think this is dollar yen. It's going to pull a fake out on everyone and rip into the median line before turning. But I can't get excited on getting long here into resistance. And with the same point, the short fizzled out real quick. You got a momentum bounce right at, you know, right a little bit deeper into 40 yesterday. So this thing is just, you know, it's not ready to turn over just yet. I do want to see it lower. I do want to see some sort of near-term exhaustion to these highs, but with Fed on tap, the open of November trade, and NFPs right around the corner, it's a tough call. It's a tough call. Watch 1450 for resistance again, the median line just above that. Okay, that's dollar yen. Any questions on that? I'm just going to kind of whiz through that, guys. A lot of these trades, as I said, you know, they go into these holding patterns right ahead of major event risk, and you know, we're still broadly within the range of the last couple of weeks on all these trades. Sterling is the only one that has been in, you know, in cahoots with us. Has been working really well. So I can't really complain about this one. The only thing I do want to note, guys, is that there is some stronger divergence starting to pan out here into these highs, and you look to see a little bit more of a possible near-term pullback, just on account of, again, the major event risk we're at. We're heading to the upper end of the range that we've been trading in, and sure, you could see a little bit more of a kickback from here. So if you're holding long still, I wouldn't necessarily shake you out, but I would look to take a little bit off the table, if not bring your stops up. The BOE is on tap tomorrow, so you got major event risk for the pound. Here's what it looks like on the weekly chart, and this has really been our major focus and guidance for the last few months. It's really the emphasis on the break that we made back in early September, on the break of this long-term trendline resistance, the basic consolidation pattern that we were in, and the current operative slope off the lows. Really kept the focus higher while above this region. Once we broke higher, we brought that up to the reversal day close. That's 130.36. The daily chart shows 130.30 or 130.20, I believe. And as long as price stays above that, you know, I have to still stay constructive. We could be wrong, right? It could break below 30.30, and if that is the case, all bets are off. You can probably see it drop pretty quick right into this region, into the 2760s. But you're in the trend until you're not. I hate those cliches, but it's true. So that's the pound on the weekly front. The daily picture, okay, shows us this was the October range open. We dropped. We made a range high in October, just below the monthly open, and then we held that into the close. So we still need to focus on a range break of this critical zone. Okay, the highs being 133.40, let's call it, and the lows 130.20 is a basic 38.2 of the yearly range, and slope support. The weekly chart had that reversal day close at 30.30. Well, you're basically getting a nice little cushion zone there of key support. Okay, it would necessitate a break below the 100-day moving average, which has been a decent support all year long. It would take a break below the median line. It would take a break below that 38.2, and that's what would put us firmly on a target initially into 128.50 if it were to happen. Not my base case scenario. Okay, I want to see this hold this support, and I do want to see it pop through those highs. Last month's open, it could be a soft target near 33.90, I think it was. But really, 34.80 is kind of where I want to see a next topside target on a rally here. Intraday chart looks like this. Boom. Pretty clean. Okay, so there's last week's high. I like that we broke it and found support there and moved higher. My concern is for near-term exhaustion just on account of the momentum signature here seems to be turning. And as I just showed you on the 120-minute chart, weak divergence, but it is starting to mount some more. So these 2 points were still divergent because they had equal highs. He did make a lower high, albeit both of them above 70, so not a very strong signal, but a signal nonetheless. So don't be too surprised if you see a little bit more of a correctionary pullback here. I do want to stay constructive. For sure, at least near term above the weekly open. I don't think you even get that low. Let me scope something out real quick. Bear with me one sec. Okay. Watch this zone. If we were to move higher, I would be weary of that. That's 100% extension. It's also the monthly open from last month. It gives you basically resistance just below the 34 handle. And this is going to get messy. I just want to see what it looks like. Look at that. Resistance, resistance, resistance. Not bad. Towards tomorrow's BOE interest rate decision. Huh. Okay. I know this chart's getting a little cluttered, guys, so bear with us here, but it's pretty interesting the levels that are just coming up. Look for some reaction around that median line there, the 50 line. You saw some hesitation here, but really the tell in my book is the acceleration break once it gave out. So even if this corrects lower early in the U.S. trade session, guys, look for support around that median line. Right now it comes in somewhere around 32.50 for near-term support. And then if that does hold, I think that's going to be kind of the tell that we have, that we've correctly identified that 133.90 target. That's very interesting that it came up there just now. Questions on sterling? Morning, Michael. As long as sterling is held 130.20 and we are in a wait mode, for having good level to hold it long. What is the best level you advise for jumping into a long position? So it depends what you're trying to do, Eman. For a near-term approach, and that's my focus, right? I don't really hold trades for weeks on end. It's just not my style. But for me, the focus right now, regrettably, I don't have anything left long on the side. I kind of just kept on chipping away at it, and I got nothing left now. Once we got through here, I thought we were going to get failure in a pullback, so whatever. Obviously, hindsight's 2020. But from here, for me to get back long, if we were to dip into this region and see a recoil action, depending on how the market reacts, that would be sort of a decent region I would trade against to the long side. But if you're looking for a longer term position and you're trying to target something above 35, for example, you're already at a disadvantage just trying to get an entry for that. And that's where the swing side of things come into play. And me and Jamie talk about this all the time. He loves this trade too. But from a swing side, we still need to see a little bit more price action develop for us to get a decent risk reward. Because remember, guys, knowing the direction's only 50% of the game. It's how you trade it, what the setup is. That's the conviction. So I would look for support right along this median line initially here, Eman, today. If we get a pullback and I see a rebound or a reaction, I would like to fade that move. If this doesn't hold, I'd have to be a lot more cautious to see a move back towards the median line here if this is in play, if this slope is in play. Almost similar, almost identical slope. Not quite. Off by a couple of degrees, but also highlights the same region for support. Also highlights the same region for resistance. Make sense? Iman says, yep, got you. Thanks a lot. Hey, you're more than welcome. More than welcome. Brace yourself. BOE is likely to be big. And again, just a quick preview of that. I don't want to get too much into the fundamentals, but there's this whole counterbalance that the argument that the MPC, the Monetary Policy Committee for the BOE makes is that they don't want to tighten too much. Well, let me read you what Prattle has us this morning. They also gave us an update on the BOE. BOE likely to hold rates and signal willingness to hike if inflation rises further. The UK economy remains on the verge of stagflation conditions, with inflation around 3% and GDP growth at just 0.4%. This presents a serious problem for the single mandate bank, whose sole objective is to maintain low and stable inflation. Should the BOE hike rates to rein in inflation, policymakers risk throwing the UK economy into a recession. Struggling Brexit negotiations only add to the downside risk facing the UK economy. This helps explain why sentiment from the BOE has plunged in recent weeks, even though inflation is above target. Despite a great deal of speculation about a possible rate hike to curb inflationary pressures, recent dovish communications indicate that policymakers remain more concerned about the downside risks associated with the Brexit than those associated with inflationary pressures. This week's inflation report, monetary policy summary, and minutes will likely point to concerns about slow growth as the rationale for holding rates, but also signal a willingness to hike should inflation rise further. That was a mouthful, guys, but that was jam-packed. I hope you picked up all the key notes there. The main thing they have to keep in mind is that unlike the ECB, the Fed rather, which has a dual mandate of price stability and fostering maximum employment, the Bank of England has a singular mandate of just price stability, i.e. inflation. So with inflation above target already, 2% target, inflation is running at 3%. the conventional wisdom from a central bank monetary policy was that you'd have to raise rates. Now, the reason they can raise rates, or the reason they're reluctant to do so, is because growth is anemic at just 0.4%. So they don't want to raise rates and hamper growth, but at the same time, inflationary concerns are starting to really boil up. Add on top of that a sprinkle of salt with the Brexit being a major unknown factor, right? The X factor. So this puts the UK, the BOE rather, at a really very difficult stance between a rock and a hard place. Expectations, guys, for tomorrow are all over the place. I just took a quick scan over the Bloomberg terminal, just a couple of different go-tos that I always look at. They're all over. There are some guys they're definitely going to see a hike tomorrow, 100%. They can't stay this way with 3% inflation. They run the risk of really letting that. Let me take a step back. Fighting inflation is a lagging indicator. When inflation starts to rear up, you want to be ahead of that in policy. And the major concern, something that the Bank of England is notorious for, is falling behind that inflationary curve. So, look, I don't know if they're going to raise rates or not. I'm still of the humble opinion that they probably hold. Like I said, Prattle is saying that they think they will hold as well, but there has been a swath of research I've been reading that have all been suggesting they might hike. Listen, from a technical standpoint, from a trader's view, which is the only thing that matters to me, pound is poised. I want to see it higher. If they hike rates, awesome, cool. Okay, that's going to only further, fuel sterling strength, which is something at this point that it'll be a welcomed addition to the BOE. Not because, again, a stronger pound is going to help stem some of that inflationary pressure. So that's my story. Sorry it took so long, but very interesting notes there from Prattle on the BOE. Look, if we get a knockback into this support, look for support, like I said, around 32.50, 32.30s even, to see if we can't get that upside pop. Really, the major resistance breach you need to see is 34 to mark a validation of a major low being in place. Till that happens, looking for a pullback to buy again. Questions on pound? Took a lot of time on that one, sorry. Okay, so the BOE, you guys are all ready for that tomorrow. That's number 4. Number 5, I just want to take a quick glance at Swissy. I'm not trading it, but from where we are right now, it's not too surprising. So earlier in the week, I did highlight the Swissy on the Sunday update here, just because I wanted to show you. So the pound levels remain unchanged, guys. I just added that pitchfork, but the pound levels remain unchanged. For Swissy, I just noted that last week we tagged a perfect kiss and touch of that 50 line. You can see that the bottom side of that 50 line was very, very nice support. The top line saw a perfect tag on Friday before closing well lower on the session, below that 99.90 level, which was the 618 of the entire December decline. So on whole, the thing looked vulnerable for a little bit of a pullback, but as I noted, ultimately you do want to be long this pair. Okay, we made a major breakout of the yearly pattern. We broke above the 200-day moving average. We broke above trendline resistance. We broke above the median line, and all that. Excuse me. All that does keep the focus weighted to the top side. Here we are. That rejection that we saw last week off that resistance level did see a little bit of pullback again the next day, but once we pop back above 99.99, again we're right back off to the races. Resistance, look for some sort of reaction near the monthly high from last month, but really the upper parallel based on time is going to be somewhere in this range right above the 1 handle. So 10060 into 101 really for resistance on dollar Swiss. Momentum is an overbought. You are seeing, if we are to make a new high, watch if we do get a strong divergence signal here, that could be a sign of exhaustion on another tap of this trend line before pulling off. But Fed, NFP, chairman announcement, all over the next 3 days. I don't want to take a bet on the short side of this until we get some further conviction and price action. Okay, so look for a reaction at one of these levels. Not my favorite trade, but something that we've been following, and it looks pretty clear. The momentum is kind of just drifting, but the levels look pretty clear as far as what we should be looking for tomorrow. Moving right along to Kiwi, one that's offered a little bit more of a better play here. This is number 6. Here's what Kiwi looked like last night. So we went over all of these. We'll go over dollar CAD in a moment. Here's what Kiwi looked like earlier in the week. The major thing that I was kind of highlighting to you guys here was that 68.27 level into 68.50, I believe it was. You had the low close, the low week reversal close rather for the year. You have the 2016 open, a decent pivot in price. If you look at this at the near-term charts, or before we do, I do want to note, and I highlighted this earlier in the week, that at the end of the day, this was a big break. Okay, and below 70.40, essentially the 70 handle is what I have noted in there. You got to look lower. You got to look lower. It's just that we're coming up against the objective yearly opening range lows. So sure, it's worth a bounce. Here's what it looks like on the intraday charts. And again, you saw the hesitation in momentum, and it looked like the oscillator wanted to make a break through 30, risking the possibility of a near-term pop higher before moving lower. Intraday chart looked like this on Monday night. Okay, looking for a stretch into 69.20. This is an area of which, if we get into 69.70, I would love to start to see some resistance. I would look to fade, and 70 is going to be our bearish invalidation level. So the immediate risk for a rebound higher, ultimately, I am looking for exhaustion at one of these two levels. Broader bearish invalidation is right at that 70 handle. Here's what Kiwi looks like now. Kiwi. Okay. So let's start off with the daily chart first. So again, yearly range lows almost to the pip, caught. 2016 open, and again that 2017 low day close. This was also the low week close that we looked at on the weekly chart is 68.50. So 68.50 into 68.28, really the major area of support that you need to break. Ultimately, there's that 2015 trendline support in red, and you stay bearish below that. Okay, that gives this thing room, even on a stretch into the 70 handle. I'd be very mindful of being long anywhere into that. I'd be looking for exhaustion into this region. Intraday chart looks like this, pretty clean. Again, yesterday you got the release of New Zealand employment data. There's some caveats in it. The major headline figure definitely saw markets really react positively to it, but there was one caveat in that the participation rate was lower than expected. Unemployment rate came in at 4.6 from 4.8. We were expecting only a downtick to 4.7. So that's kind of the headline that everyone ran with. Embedded in the figures, you did see strong employment change quarter on quarter, 2.2%, year on year, 4.2%, bucking expectation of just 2.5. The one caveat is the participation rate did uptick. Okay, well let me take this back. We were at 70%. It saw an upward revision of last month's print to 70.1. This month we were expecting 70.2, and it came in at 71.1. So the participation rate actually was better than expected, which shows the caveat that it's not just all job gains. There's actually more labor market or more slack coming into the labor market. So those discouraged workers, Canada doesn't define it the same as we do in the United States, but more people returning back to the labor force, and of those returning force workers, you're getting immediate employment. So the picture is pretty strong. As I said, I'm not expecting that rally to last. I think I noted that right in the yeah, but I'm not expecting this to last too long. I thought I noted that yesterday on the Kiwi rally. It's just because, remember, the major focus is still lower. So sure, it was definitely worth a long into 169.20. If you're holding long still, I wouldn't necessarily get out. 69.70 would be your next upside target. Depending on where your entry is, I would definitely have it at break even if you're above 60.50. If you're not, below the lows there. But at the end of the day, it's still a major break of support. We're just coming into a level of support within the downtrend. So I do think you could still see another stretch higher, ideally towards the median line. For a fade type of move back to the downside, but again, dollar price action event risk still on tap over the next 3 days. I'm just looking for a rallied sell at this point. Chased a little bit of it yesterday, I'm not going to lie, but I'm not going to encourage that. Questions on Kiwi? Okay. Euro yen, number 7. It's been an interesting pair that I didn't even know Jamie was looking at till just a couple of days ago, but we've been following it here very closely too. The major emphasis on the euro yen trade was just the basic region of which we turned from resistance. It's a 618 retracement from the decline off the highs that you made there in late 2014, excuse me. It literally clipped the high right there. Literally clipped the high right there. Look what happened. A reversal day off resistance at the highs. Wasn't an outside weekly reversal, but was a reversal candle. Took us below that basic trendline support. Don't want to focus on the trendline support right now, but I just want to show you a couple of different things. Momentum, well, didn't quite get divergence, but you do see that we're continuing to be unable to do anything around that 70 handle as far as a topside break. And while the broader trend is constructive, in my humble opinion, near term, sure, it's at risk for a pullback. It's at risk for a pullback. Here's what it looks like on the daily charts. And why I love this setup is, again, simplicity is key. The best setup sometimes, guys, that we'll make and we'll trade are the ones that are just the simplest. Not overly overt and all complicated, but this one to me is kind of just a gift. We opened the month of October. We're now in November, so the monthly open is kind of not going to be the major focus, but the fact that we still held the October opening range makes this clear as day to me, okay? Here's the October open. It's a perfect bisector. Here's your October high, was right at the 618. That's also the yearly high. That's also a Fibonacci consideration of longer term. The low was right at the monthly opening range lows. Sure, we probed a little bit lower, but we couldn't make a close anywhere near that. And you really have a very well-defined, clear-cut range. Ideally, we hold right here, to be quite honest with you. I'll show you the near-term chart in a moment and why I think that, but that's the ideal scenario. What we need to see to validate that a more concerted near-term high is in place is a break below here. Former swing highs, basic 50 line for the current operative slope that we've been working with, and the October range lows. Okay, so that gives you basically 3150 to 3170. It's 20 pip region here. This is what we need to clear. On a downside break, beautiful targets. You got the 100-day moving average, which is just a soft target. I would take a little bit off the table there. It's right around 130, 130.30, okay, 130.33. But the measured objective move of that, it would be a double top type of formation break, takes you down into 28.80. Longer term, right? This is a longer term view from 1,000 feet. So I want to show you. So how do we trade this on the intraday? Well, that's where I come in. So I want to show you a couple of different things. I did this with you yesterday, I think. So I think Jamie's looking at this slope. And while we were discussing this yesterday in the webinar, I was more inclined, I'm always more partial, guys, to work with the slopes that are deader, the ones that have a deader gradient. Because, typically markets just won't hold real sharp, pitched formations for too long. And even if they do break, the break doesn't usually give you as much of a run as it does for a gradient that's a little bit more gradual. So I was more inclined to work with this. You saw really nice resistance, hesitation at the median line, the break fueled acceleration. Obviously the 50 was messy, and I don't know what I want to do with that. If I bring into account Jamie's view, which is this pitchfork. Little messy around the median line, but it does highlight where we just peaked. And again, that's the October open at 132.82. We were just looking on that on the daily chart as the bisector for basically the monthly range. So was that it? I don't know. I'd like to think so. I'd like to see momentum hold 60 on intraday charts. I'd like to see a move off that level. Any type of short exposure that you want to take, it's actually not too late yet. If we were to get another push or kind of a straggle here as we open up the U.S. trade session before we move lower, a stop against that high, I'm cool with that. Looking for initial targets just at the 32.28 level. Wouldn't necessarily close it there, but that's a level we'd need to get through, and then you'd look for resumption of the continual downside. But whether you're working with this slope or not, we'll continue to go back and forth to kind of see, how price action develops. A basic retracement is something that is viable at this point of just the near-term decline since we've made that reversal break. Hello? And the reason I wanted to add that was because when you do this and then you bring this pitchfork back into view, the 618 converges up here on the 50 line. Sorry, guys, I'm losing my voice way too early in the week to lose it. I still got so much event risk on tap. Oh, goodness. 133.33 is the 618. And if we stick with the initial interpretation that we were working with, that puts resistance or the next major resistance level up here. Okay, not my ideal scenario. I kind of do like, at this point, working with the slope Jamie's been looking at, just on account of the most recent high-low. If we hold this high, it would be encouraging. It would be encouraging for a move lower in euro-yen. And if the yen won't turn around against the dollar, hopefully we can get some strength against the euro. So let's see how that pans out. D says, good morning. Keep forgetting we have changed our time by an hour. Can we have an archive ASAP, please? Yeah, D, I'll have this archived, as always, as soon as possible. That's right. So you guys in the UK, you're on daylight savings time. We're going to go move to that here next week. So for this week, there's that disparity between the GMT. Okay, any questions on euro-yen? Looking for conditions of a turnover here. I do like a hold 32.80 ideally. If not, look for 33.33. 133.33 would be the level that would coincide with the initial original formation we were following. So that would be the next sort of level I'd look for exhaustion. Okay. I do want to go over Bitcoin and Ethereum. We do have a couple minutes left, but I just want to touch base on Euro. There's a reason I left it out, guys. I'm not comfortable with where we are right now. I like the short side. Obviously, the head and shoulders measured move takes us way, way down lower. There's lots of room for it. Whether it's actually going to pan out or not, the rally that we saw in overnight kind of fizzled. I would have liked to see a 116.80 clip for an entry, or even 117 for that matter, but you didn't get it. And here's the turnaround. So at the end of the day, the weekly opening range lows, once you clear that, 115.50 is the next downside target. Largely speaking, this is kind of a beautiful zone I want to do want to see at 114.20. That's a little bit far from where we are right now. But the play, in my opinion, was for a move back into this to get short, and we're not getting it. So I'm not going to chase this at this point, but just know the euro made a pretty big break last week of that major longer-term slope we've been following off the yearly lows. And if this head and shoulders is in fact in play, I thought I had it on the weekly charts. A measured move of that actually takes you all the way down to 112.30. Now again, I've been doing this long enough to know nothing is certain. These head and shoulders formations, they are typically decent breaks to play with, but the measured move, I think it might be a little unrealistic in this point, just because, well, let me take a step back. It's a longer term play. Okay, if you're looking at the head and shoulders formation, you would want to be drilling down into like intraday charts because you have to be patient. That might take a couple of weeks, if not a couple of months. But near term, certainly the focus for me is whether we can get some sort of better reset to get back on the short side. So not really my favorite trade. Here's what I've been looking at. If you guys want to take a snapshot of this for your reference, please feel free to do so. But I'm more inclined to sit this one out on the euro. So much event risk on tap, guys. So much event risk. So expect volatility. We've been holding these tight ranges since the start of the week. As we get into FOMC, guys, literally over the next couple hours, things are likely to flatline. And then tomorrow, God knows when we're going to get that release from Trump, but if we do get the chairman nomination, that's going to be, I think, what the market's going to take cues off of. Somehow that head and shoulders feels too obvious to work, says Pooja, and I didn't want to say it in those terms, Pooja, like you just did, but since you said it, that's exactly what I was referencing. I hate being on the bandwagon with everyone, and that thing has been pointed out by so many sources, and sources of guys who I typically like to fade, to be quite honest with you, not to be a jerk or anything, but there are guys out there that, you know, just being in the business as long as I have, like I said, when you see them get really strong convictions on something, you typically want to fade them. So yeah, I'm with you 100%. There's so much talk about it that I just, you know, markets don't reward the masses, guys, and if everyone's talking about it, it's probably a good indication that it might not pan out as well. All right. So Pooja, I take your comments there 100% to heart. I'm with you. I'm with you. Kelly says, so enjoy having a cup of hot coffee while taking in your knowledge and guidance each morning. Cheers, Kelly. It's great to have you in the room as always. Do you want to take a look at Euro Key? You know what? I haven't taken a look at that in a while. What's that thing doing? Well, I put a marker at the start of the week, so I definitely took a look at it. Huh. All right. Okay. Interesting, D. So if you guys recall, we were working with this ascending slope formation earlier this year, and it has been just, I'm surprised that we're still in it. Support, resistance, kind of shot through the 50 line, the 50 line, the end, and the bottom end held, upper parallel, key support. Now at this point, you're going to want to note that around here. That's the breakout. Actually, 764 will probably take us right there. Yeah. Wow. Might as well bring up the 88.6 and the 1. That's ugly. Where's the 618? Okay. So you saw you saw that the 1618 extension came right here. That's the level we were highlighting anyway as just a major swing high. I don't want to stress that because price action obviously hasn't seen too much reaction off that threshold at 169.30 as of late. This looks very interesting to me. Who brought this up? D. 69.90. So take a look at 167 basically. See if we can't get a drawdown into that region. My concern with this is that I do think Euro does risk a little bit lower, right? I don't know if I want to look for the head and shoulders objective of 128, but I do think the Euro looks a little bit lower. My concern is getting too aggressive on the long side of Kiwi, which is what you're basically long Kiwi on the short side here. That's my only concern. But yeah, I think a move into 66.90 would be welcomed here, at least on this drawdown. See what it looks like on the intraday. Ooh, that's a pretty big confluence right there. And it's a pretty big confluence right there. That's the September high. Converges on the 100% extension, so 2 equal legs down would take you there. I just wish I had some slope to this. It's aggressive. It's real aggressive slope. I don't like, again, those really strong gradients. But that would still put the target at 66.90 on the downside. And then obviously, depending on where we are in time, guys, that's that slope confluence as I talked about earlier. Resistance and bearish invalidation is what I would want to focus on for you here, D. Yeah, everything keeps pointing to the same region. So the hourly reversal close is usually what I like to look at as far as the major or the first targeted area of resistance where prices would fail. That continues to highlight the same regions, basically 170.20. It's a ways away from where we are right now, and it's not. I don't like it, but that's kind of where you need to see. Was targeting 167 on the downside. Oh, perfect, perfect. Yeah, so I have 166.90. It comes up twice. Okay, it comes up as a former swing high from back in the September. Basically, it is the September high, and it's the 100% extension. So if this is just a correctionary bounce, it's 2 equal legs down, just a simple ABC pattern takes you into 166.90. So I love that target. I'm just trying to figure out what your bearish invalidation would be near term. It still needs to be up there, to be honest with you. I really wouldn't, even if we were to test slope resistance, it is only a 2-point touch. 3? No, it's only a 2-point touch, so it's not the most convincing thing per se, but I do like the target on the downside at least. So D, get protective on this one. Oh, you're short from 170. Okay, nice entry. Nice entry. So, yeah, you could put it at 70.30, 70.20 as far as your stop's concerned. Ideally, you'd have against the weekly opening range high. It's kind of far out, but I wouldn't want to see you take a loss on that. So, honestly, break even for me would be on that trade. You're really banking on this push. See if you can get below 68.30 on a better move today, and you'll be golden, I think, for that 67 target. Stop at cost now, right on. Well played, D. Well played. Let me say this. The immediate, like we said about the Kiwi, right? It still could pop a little higher, so that might fuel you still. But the broader Kiwi downtrend was it has me too concerned about getting too aggressive on looking for any type of long Kiwi exposure. Euro might still carry that to the downside if we do break, so keep that in mind. Yeah, you're more than welcome, D. Says thanks. Okay. Oh, goodness. We're at the 30 mark. So really quick, guys, last night's update, we did go over some basic stuff. I highlighted, again, the Kiwi trade. No changes to any of those levels. Bitcoin, what I meant by it's all emotion here, I got someone asking me what I mean by that. Basically, it's all speculation, guys. You're not, at this point, you're not really trading on any fundamentals. You're trading on news announcements. You're trading into uncharted territories. There is not many measured moves beyond this region. You're dealing primarily with slope. I don't have anything near term, which is why I didn't even show it to you. But the 70 handle is likely to be 7,000 is likely to be just a psychological barrier. So I personally think you'd see a stretch that would fail right ahead of that if we do push higher. What I wanted to show you yesterday was that this is the 50 line, the 150 line of the same slope. So 150% extension of a measured from the median line here takes that. Literally caught the previous highs, caught the high that we made back here, on Monday, I guess it was, and we were heading into it yesterday. Here's the push. Okay, there's really nothing beyond here to work with, guys. 70 handle will be that psych figure. Got a 138.2 measured move. The reason I put credence to this is because the 100 did offer a very strong reversal. I mean, with respect to Bitcoin, which is up 500% on the year, that's a pretty decent reversal off that level. So I'm inclined to still work with this extension. It puts the 138.2 up at 73.25. The 123.6 comes in just a little bit earlier at 68.65, but you get the picture. By no means am I advocating any type of short on this, but if you're holding long exposure, these are levels at which you'd want to start to look for possible exhaustion. Okay, Ethereum, I think, is the one that still has a possible play for someone who's not in it yet. Obviously, price action on this one has still continued to hold that godforsaken range that we talked about early in the month of October. This break did see a click or just a tag of our initial target before we came right back, and that's now still the range of focus. So even on the near-term charts, this is what we were looking at earlier in the week. And remember, we talked about the break of this near-term descending channel formation. So this shifted the focus higher for me. We fizzled, the first target one at 303 got hit, but this one fizzled just ahead of that beautiful Fibonacci convergence area of 312. So I highlighted this yesterday with near-term support at 300 into 303. We broke. Bottom end of the range still gives you room until 287, but if this is going to play catch up with Bitcoin, I do inevitably want to see some sort of low ahead of the monthly opening range lows for October for this thing to turn higher. All right. I apologize for my voice giving out today, guys. I'm not sure what's going on. But I want to thank everyone for coming. Again, if there's any other questions, feel free to throw them on the message board real quick. If not, good luck today. 2 o'clock is when you'll get the release. Dollar CAD should be on the menu if you have time, please. Eman, did we not go over Dollar CAD? Where is my head? Here's Dollar CAD. Absolutely. No, I'm not going to close before going over Dollar CAD. Here's Dollar CAD. The major area of resistance, 129.27. In 2029.30 or 40 area, you have basically the upper parallel here. You have a 50% retracement. Major area of resistance. The thing I started to note for you guys earlier in the week was that, look, this thing is still in overbought territory on a daily basis. I do not want to try getting cute, trying to short it, but you are getting some interesting developments. You haven't necessarily gotten strong divergence yet, but it looks like it is impending with another push higher here. We were talking yesterday about just wanting to stay short while below last week's high. Now that time is kicked out that far, you could see last week's high compromised before it turns around and nestled right into this still pocket region. So for this trade, if you're not already long, I don't think there's anything new for you. If you are already long, you're looking for a little bit of a limit to take some off here. The second region would be here. This is where I close out the rest of the trade, but I am expecting some near-term exhaustion off one of these two marks. But as long as daily isn't overbought, I'm not going to be that fool trying to call the high. So, Eman, it hasn't been something that's been on my radar immediately, just because on this drop here, I told you guys earlier in the week to focus on a break of this range. And ideally, a break of that range to the downside gave us a target here and look for a deeper cut to get back on the long side. The fact that the range held that slope and now we broke the initial weekly highs, does suggest, again, you could still see that last spur into the opening range for the month to the upside. Does that make sense, Eman, on where we are in Dollar CAD? Remember, the focus and the reason I'm reluctant to get further long or to get on the long side if you're not already from here is because the weekly charts, a basic objective 50% retracement of the yearly range, and certainly this slope that we've been working with, a modified slope off the highs from 2016, puts the 50 line right there. So sure, you have the targets to look for on the upside if we do break, but right now, I'm not going to try to call a high on it, especially in front of all this data. Don't forget, For Canada, Eman, the most important thing we also keep in mind is Friday, double whammy employment jobs data. I love those Fridays for $CAD. You get the NFP report release and the Canadian jobs numbers at the same exact time, 8:30 Eastern, and the divergence there of the two can sometimes give you some radical price moves. So, an exhaustion high push, maybe on the table. I'd be definitely interested in something like that. But that's kind of what I'm focusing on for the $CAD. If we get some sort of exhaustion push, one last push higher into the 129.50s would be very interesting. All right, Amanda, I hope that helps. She says, thanks, hope you feel better. We need your voice. Yeah, cheers, me too. I will tend to that. In the meantime, best of luck trading today. Again, watch the Fed interest rate decision. If you don't get too much of a reaction, don't get too concerned. There might be a lot of market participants on the sidelines waiting for the ultimate chairman nomination from Trump. That'll be the bigger impact. Why? Because that's what's going to impact the pace of monetary policy moving forward. Markets are baked in for December hike. So nothing today is really going to be relevant, and especially if we see a new person at the helm, which we will see a new person at the helm, that person's tendency to be either more of a dovish or hawkish stance is what the Fed going to interpret, is really what the market rather is going to interpret as the biggest impact on monetary policy moving forward. So, unfortunately, with all those event risks stacked up back to back, it makes for a tricky trading environment. But I do think we get the volatility on these releases heading into the close of the week. Okay, best of luck trading, guys. Sorry I went over on time today. I will be with you tomorrow morning, 8:30 Eastern. We'll cover the aftermath of the BOE interest rate decision, and we'll give you a quick preview again ahead of non-farm payrolls on Friday. Best of luck trading, and I'll see you tomorrow. Cheers.